So if you're still making trading decisions based on candlestick patterns, you're playing checkers while Wall Street is playing chess. So you gotta understand, the big money, the money that actually moves the market, they're not looking at the same charts as you are. They're trading off what I'm about to show you in this video. Now here's the main issue of trading the traditional candlestick charts, right? You can see right here, this was previously all-time highs at the end of July. You can see that there is very heavy selling here, right? We sold off a lot at this level. So the typical retail trader will mark this as resistance. Like, okay, this is a big resistance level. And what happens here? Right, yesterday, as you can see, we rip up through this level. This could have avoided you from taking a really good trade to the upside, or even worse, you could have had a losing trade because you start shorting here because you think it's resistance. And in fact, you can actually see, I actually took a trade long inside of the zone, and I didn't even have the zone on my chart because I don't care about it, right? You can see I trade on a 1 minute chart, but if we actually go into a 1 minute, as you can see, I was going long in this resistance area, taking the market up because again, I'm not getting my key levels in my market context based on candlesticks from previous weeks or days. Now, why was I bullish and looking to take long setups on a day where we're in a massive resistance area right at all-time highs? Well, this is because the market does not move off of candlesticks. It moves off of the options market volume. Did you know that 80% of the volume in the market come from options, which is 4 times more than the futures volume? This means that the majority of market activity is not happening on the candlestick charts, right? The candlestick charts are just representation of what price did. The majority of the volume is happening inside the options market. Options market is what moves the market from a day-to-day basis. Because again, 80% of the volume comes from the options market. You can fact check me on that, but that is the reality. Now I made this flow chart to kind of make this make more sense, right? So if 80% of the volume in the market comes from the options market, this means that there's going to be massive dealer and market maker exposure, right? Because every time you sell a put or you buy a call, someone has to buy that put from you or sell that call from you. And we call these people market makers. These are liquidity providers in the market. Now, these people are big institutions, big banks, and what they're doing is they're not trying to make money they're not traders, right? They're not trying to make money from it going up and down. All they're doing is they're providing liquidity to the market, buying those calls from you, buying those puts from people. And what happens is if they have to buy a bunch of puts from people, they have to hedge their position so they can stay neutral in the market because they are not trying to make money off of those puts or calls. They're trying to make money off the spreads and the fees of the liquidity they're providing. Now, a little bit easier analogy to kind of make this click for you because I want you guys to understand why this happens. And then we'll get into how do we actually trade with this data, right? How do we actually get our key levels with this data? So think of an airline, right? Let's say you buy an airline ticket to Hawaii 6 months out from here. Now, what happens if the price of gas doubles in the next 6 months? What's going to happen is the airline company is going to lose money on the $500 ticket that they sold you because the gas prices are going to be twice as expensive. So what the airline companies will actually do is they'll hedge their position with those airline tickets, right? So in case gas decides to double in the next 6 months, what they do is they go and buy the futures contracts of oil, right? So if gas doubles in the next 6 months, they're going to make money on their futures contract. Now, what if gas does not double in 6 months? What if it goes down? Well, obviously the airline company is going to lose money on those futures contracts, but now gas is going to be cheaper. So it's going to be cheaper to fly them to Hawaii, right? So they're trying to stay neutral. And this is exactly what these market makers are doing. Now, once we understand why dealers have to hedge their positions, now we can actually look at the Greeks because they measure this flow, okay, between gamma, delta, charm, and vana, okay? They actually measure this flow of where big hedging is going to take place, right? You can actually see it inside the Greeks by looking at this data. What happens is inside the Greeks, you can see predictable push/pull, right? So basically looking at key levels in the market, right? So these Greeks will create key levels in the market and you can see the overall market context. And then what happens is candlesticks will react based on what is happening in the actual market. So the last thing you see is the candlesticks. And this is what everyone trades off of, right? And it's reacting based off the move. Okay, so once again, just to recap this, 80% of market volume comes from the options market. What this does is it creates a massive dealer slash market maker exposure because they're providing liquidity to all these people trading options, this 80% volume. And what happens when these people provide liquidity, they have to hedge their position so they can stay neutral in the market, just like the airline companies do. And now we can look at the Greeks to see what hedging activity is likely to happen, right? Where are those key pressure points? How much pressure is on the market at this certain level, at this certain level? And what this does is it creates key levels for us to mark on our chart before we see any candlesticks. And then from there, the candlesticks will actually represent once price gets there and see and it'll show what price actually did once we got to those key pressure points. So now that you kind of understand how the market flow works and where the big money is actually trading, I'm going to roll a clip from a training I did a few days ago. It's a private training I did with my students, and it's going to go over everything in depth as far as how to actually read these Greeks. What is a gamma? What is a delta? What is a charm? And then using that data to show you real trades I took in the market, real setups you can actually look for each and every day using the Greeks. So anyways, I'm going to go and roll the clip. Hope you enjoy this private training we did. All right, so in this training, we're going to be going over mastering dealer positioning levels, the secret hidden levels that move the market. All right, so this is not looking at candlesticks and looking, oh, it looks like we consolidate up here, we sold off, this is our resistance area, or vice versa for support, right? This is not looking at the chart, not looking at candlesticks. We're looking at the Greeks in the options market. Okay, so I'm going to do the best I can to explain this, but it's a little bit complicated, and I'm probably not going to be the best at explaining it, but I know how to read it. Okay, so really you just need to know how to read it, but I'm going to try to explain how it works to the best of my ability. If I make no sense to you, you can watch some YouTube videos online about it too. But anyways, let's move on, okay? And I'll show you kind of how I see it and how I use it. So hopefully by the end of this, you'll understand how to read gamma, delta, and charm levels, also known as Greeks, like a map, so you can anticipate where the market might accelerate, reverse, or stall before it happens, all right? So first thing is why dealer positioning matters, okay? So most indicators react to price, all right? You probably know this, like a moving average, a MACD, RSI, they're all everything they show in the indicator is based on previous price action. Okay, what the Greeks do is they help you predict what's going to happen ahead of price, essentially. Okay, by looking at the order flow of options, looking at where the demand and supply is in the options market, and what the market makers or dealers are going to do based off of that data in the Greeks. Okay, so we have to position ourselves as what would the market maker do? Where are they going to be buying or selling and hedging their positions so they can stay neutral in the market? So first things first is why this matters is 85% of volume in NQ and SPY comes from institutions. Okay, and most of them hedge via options. So what this means is these market makers, these big banks, what they do is they provide liquidity to the market. For example, if there's like tons of people buying options at 570 on QQQ, what happens if someone buys, someone else has to sell, right? But it's not always a trader on the other end. So there's big liquidity provider institutions that provide that liquidity. So they're going to be selling option contracts to all those buyers. Now, these institutions, these market makers, these dealers are not trying to make money. They're not traders, okay? They're not trying to make money from the price going down or up. They're simply providing liquidity, and they're making money on the fees and commissions. So their job is to stay neutral in the market. So if they have to sell a bunch of option contracts to a bunch of buyers, what they have to do is they have to hedge their position so they can stay neutral in the market. Right? Because if they just sold a bunch, right, they need to hedge by buying in case price, goes down or up, essentially, is how it works, right? So you got to understand these people are not traders. They're not trying to make money from price going up or down. They're simply providing liquidity, and they're trying to stay balanced in the market. They're trying to stay neutral. And the only way they can do that is by hedging their positions, meaning if they just sold a bunch, they're going to buy a bunch as well. So whether price goes up or down, they're going to remain neutral. Okay, that's probably the easiest way I could put it. I have an analogy from ChatGPT. I'll go over in just a second, but essentially option dealers have to hedge risk based on where price moves. Okay, so if price going up a bunch, right, they have to hedge that risk so they can stay neutral and balanced in the market, right? Because again, they're not trying to make money off it going up and down. They're not traders. So this constant hedging flow creates predictable behavior in the markets. And, the way we can look at that is the Greeks, right? The Greeks as gamma, delta, charm show where that dealer pressure is building. Okay, it shows where that most demand or supply is and how much pressure are at certain levels, right? So you can actually see how strong of a resistance zone is by looking at these Greeks versus just saying, oh, the candlesticks looks like it sold off a bunch. There's probably a lot of pressure here. There's probably a lot of resistance here, right? This actually shows us how much pressure there is. So let me give you an analogy that kind of makes a little bit of sense, or hopefully should. So, for example, airlines sell plane tickets months in advance, right? And this is a real life example. Sometimes before they even know what the price of jet fuel will be on the day of the flight, right? So if they're selling plane tickets, it's July right now as I'm recording this video, or August actually. If they're selling plane tickets in December, they don't know what the price of oil is going to be, what the price of gas is going to be. So for example, let's say you buy a ticket today for $500 to fly in 6 months. Okay, you have a flight in 6 months. If jet fuel prices double between now and then, the airline costs skyrocket, right? And your $500 ticket could become a money-losing seat for them if oil goes up in price in the next 6 months. So what do? They hedge, right? Same as the market makers, same as the dealers. They hedge their position, locking in fuel prices today using future contracts. So no matter what happens to fuel prices later, their costs are predictable. Okay, so essentially, in case fuel goes up, what they're going to do is they're going to buy a bunch of futures contracts of oil. So that way, if prices do go up, they're going to make money on oil going up from their futures contracts. And if it goes down, they're going to lose money on those futures contracts, but the gas is going to be cheaper. The fuel is going to be cheaper. So it's going to cost less for them to fly the planes, right? So they're trying to stay balanced in the market, right? Dealers in the market, market makers, whatever you want to call them, are just like the airline. When traders buy call options, it's like passengers locking in a cheap ticket. If the stock price rips higher, the dealer who sold the call is suddenly on the hook to deliver those shares at the agreed price, which could mean a big loss. So to protect themselves, they hedge right away by buying stock in the open market. And a lot of times they do this through futures, right? Because again, they're trying to stay balanced. They're trying to stay neutral in the market, no matter what price does, just like the airlines, right? So why is this powerful for traders? Just like massive ticket sales can cause a big rush to lock in fuel, large option buying can force a huge wave of hedging from the market makers, right? And they're the ones that are going to move the market because they control, they're huge companies. Like they're buying billions of dollars at a time. So this dealer hedging adds extra buying or selling pressure on top of normal market activity, pushing price towards certain levels faster. This is why when we get to certain levels, you'll see, us just bounce super quickly and random volumes start coming in like crazy, right? So Greeks like gamma, delta let you see where that hedging pressure will be the strongest so you can trade with the flow instead of against it, right? So we want to trade with where these market makers and dealers are hedging. That's the whole point of this, right? And we can make key levels off of that, okay? And then we're just trading that. And we're looking for, OTS indicator for the signals to go off at those levels. And that's essentially it. So hopefully that made sense. Now, what do the three Greeks mean? Okay. What do the three Greeks mean? Well, the first one is gamma, right? And this is dealer's reaction. Okay. This is how much they have to react to these certain price levels. So essentially there's going to be two different things going on in the market. We're either going to be positive gamma, and that typically means we're going to have a little bit lower volatility, or there's going to be negative gamma in the market, and there's going to be a lot higher volatility. The dealers want us to stay positive gamma because they're going to make more money that way. and their job's going to be easier. When we go negative, that's kind of when the market starts to flip and we get higher volatility. Okay, so if you ever wondered why, like, I'm sure you've heard the saying before, like, oh, we take the stairs up and the elevator down. So usually when price goes up, it's like a steady pullback, right? The stairs. But all of a sudden you see price goes down and we just dump like an elevator. We usually sell off super fast. This is because we're usually entering that negative gamma phase where we have higher volatility. So if you ever wonder why sell-offs are a lot faster, this is why. Again, this is going to make not much sense now, but I'm going to try to put it all together in this. So the next part of this is delta. This is where the positioning is in the market. So positive delta essentially means we have institutions bullish, right? They are bullish on the market. They have to buy from their hedges, right? They have to buy. Negative delta, institutions are bearish, right? This means they have to sell in order to stay neutral. That's going to be their hedging position. A tall bar, as you can see the bars right here, a tall bar means there's a lot of strong interest there. And typically the market wants to pull to these tall bar areas, making it a key level. And then a drop is interest fading or the end of the move. So for example, when we see like this bar, right? As you can see, pretty tall bar, and then it just drops off really quickly, or this bar drops off, or this bar completely just drops off. These are typically going to be the end of the move, meaning they can act as support if price is pulling down here. This dotted line is where price is. And I'm going to show you the tool that I use for this in just a second. But that's essentially what you want to know. Like tall bars are, basically just key levels. Price wants to stick around there. And then where bars drop off significantly, that's where typically the end of the move is going to be, right? So price is going to bounce off of that. Now, the next thing is charm, okay? And charm, delta, gamma, we kind of have to read all of it and put it all together with one thesis and make a plan off of that and make key levels off of that, essentially. So this is the impact on time decay, okay? So if you ever traded options, you know that price has to move to a certain point, up or down, in order for you to make money. Yes, this is true for shares features. Like if you buy, you want price to go up to make money. Well, in options, there's time decay. Okay, so you're basically saying, hey, listen, I think price is going to go up to this level within a certain amount of time. Whether you're trading 0 DTEs, you want to see that, within the same day, within the same hour, really, because time decay can really eat up 0 DTEs. Like let's say you buy at 570, you get long, right? And you're saying price will go to 572. If it takes like 2 hours for price to get to 572, you're going to be break even on the position, even though price went up because of that time decay. If it goes up within 2 minutes, you're going to make a lot of money because it went up right away, right? So time decay is very important. Charm is very important. This is the fuel of the market. So you kind of have to think of this as like the fuel, how much fuel there is, how fast price is going to go up or down. So positive charm means dealers are buying, essentially. Negative charm is dealers will sell. Charm peaking is the target zone / end of move. And rising charm equals continuation of current move. So for example, if we are right here, this dotted line, and we see bars moving up, right? We're going to want to pull to this price action, okay? This is a continuation of the current move. Or if we get down here, for example, as you can see, this is the last area. This is called the flip zone where it goes from positive and then it switches to negative. Well, look at the charm here, right? If we break below this level, whatever this number is, look at how the charm slowly rises, right? This is actually like a perfect short setup if we fall into this area, okay? If we fall into this area, there's a very high chance that we get all the way down here. And that's a big move. That's, 3 whole points on QQQs, which probably transfers to like 120 points on NQ. Okay, this is going to be a big move if we fall below that, right? So charm is going to be super important. Delta is like the pressure of the market, where the positioning is. And then gamma is like the actual target for the day, the magnet for the day. Okay, so again, you kind of want all three of these things to line up in order for us to like find a proper setup and in level and trade we want to take, essentially. Okay, and this is kind of what I make in my trading plans is I'm reading or I'm analyzing all three of those things, and I'm making a trading plan based off of that. What lines up? I'm saying like long setups to 23,616 area, right? When we're down here and I'm saying, hey, we're going to go up to this green line, it's because we have positive delta up here. We have charm increasing to this level, right? We have gamma up here, the biggest bar in gamma up here. So as long as we hold above this negative area, right, where essentially we turn negative, okay, so that's kind of what my red lines mean, then we should push up to this magnet area since we have delta, the bullish pressure up here. We have charm increasing, right? So there's time decay, there's pressure, there's feel that we're going to go up, okay, because of that time decay. It's going to happen faster. They don't want it to take 5 hours because that charm is building up, and they're going to lose money if it takes too long, like I was explaining. If you guys ever traded options, you kind of know what I'm talking about. All right, then we have a tall gamma bar up here, which means is how much reaction there is. And so the more gamma, the more likely we're going to move up, essentially. So I'll give you guys examples of this, but I'm just trying to break everything down individually first. So anyways, we got the Greeks on the left. I made this little table, little cheat sheet, if you want to screenshot this or something. But we got the Greeks right here. We got gamma, delta, and charm. We just went over all those. What it tells you and the behavior you can expect in the market. All right, so let me move myself and get my little pen. So gamma, what it tells you is dealers' reaction to price moving, okay? And how does that translate into the market, the candlesticks, the chart, what we as traders are used to, right? What does that actually mean, dealers' reaction to price moving? Well, this is basically the speed of the market, right? How fast we're going to move, okay? Because obviously if there's a bigger reaction, then there's going to be more speed. There's going to be more institutions buying or selling and hedging their positions. All right, you can also use gamma as targets for your position, and you can also use it as support and resistance zones, right? If we have a big gamma bar, that's going to act like a magnet. Price is going to pull up there. Now, again, we have to look at everything. We can't just look at one thing. I mean, you could, but it's going to be better to look at everything to confirm that. So the next thing we have is delta, right? And this is the net dealer positioning. Are we bullish or bearish? Okay, so what does this mean in the actual chart? Well, this is essentially the volume and institutional interest, right? Whether it's bullish or bearish. Again, a lot of this stuff is kind of similar, but it is, you want them to all to line up. Okay, but the more important thing for delta is just like it's how much positioning there is versus reaction. So it's a little bit different in that way. But that's kind of how you want to think of it. And again, this will make more sense when I show examples. Charm, the next thing here is the dealer hedging behavior over time. Remember, this is time decay in the options market. So what does this mean when it comes to the actual chart? Well, this means whether dealers need to buy or sell and how aggressively they need to buy or sell based on the height of the charm bars and if it's increasing or decreasing, right? Let's go over, how do you actually trade with the Greeks? Now that you kind of understand or have an idea of what the Greeks mean, what they do, how do you actually trade with them, right? So I think the easiest way for you to actually kind of understand this is I categorize this into different setups. Okay, there's 4 setups. Essentially, there's a long pullback, a short pullback, a long reversal, and a short reversal, right? We understand this as traders, right? This is also known as like, okay, a long pullback means a trend pullback. Market's trending up. We want to get in on the pullback. All right, so for this, I kind of position this in a way where traders will understand it more. So The first thing is like the conditions. What do we need? Okay, we need positive gamma, meaning there's going to be a little bit lower volatility. The pullbacks are going to get bought up, right? If you remember what we talked about with gamma. And then we're looking for a pullback, right? So we basically want us to hold above the flip. Remember, the flip area is where we go from positive to negative. Okay, so if we have positive gamma up here and we have these bars, right? And then all of a sudden we have, a smaller gamma bar, let's say, and then it flips to negative, right? And you can start seeing negative bars. Okay, essentially, if price is right here, right? Let's say price is right here, and we're at, let's say 70 to keep it easy. Essentially, what we want to see is, let's say, this is the tallest bar, right? So this is like our magnet area up here, right? What we want to see is we want to see price at least hold this flip zone, okay? So this is going to be our pullback level that we need to hold in order to not go negative, okay? Because once we go negative, we're probably going to go down quick, okay? Once it flips, it usually flips quick. Sometimes there is, defensive here. So like, because again, the dealers don't want us to go negative. That's going to make their job harder. So they're going to try to defend this whole area, right? They're going to be playing defense in this area, meaning they're going to be hedging a lot in this area, trying to push price back up, right? So we want us to at least hold above the flip. All right. And a confirmation for this is we want to see rising charm to the target and delta leading up to the target. Okay. So if we go to this example, right, if you can kind of picture what I just drew in the gamma chart, let's say for charm, right? Remember, this is time decay fuel. What we want to see is if price is right here, right? We want to see, and we have a target, let's say up here. Okay, we want to see charm looking like this. This is like the perfect scenario. Kind of like, raising the bar, whatever that, I think it's Verizon did that. We want to see something like this. Okay, rising charm. And, we want the big charm bar to line up with the gamma bar as well, the big gamma bar. Right, that's going to be most ideal, and this is where you want to take profits for sure, right? Especially if it drops off super drastically, okay? Because there's a big chance we're going to pull back off of that bar. And we also want to see delta, okay? Delta, you don't have to be as picky about, but essentially if price is right here, we have a target up here. We also want to see a big delta bar. And we just want to see some, like, it doesn't matter the order of the bars. We just want to see some positive delta, meaning there's interest, there's bullish interest up here. And that's essentially what you want to see. Delta leading up to the target. So this is good. The target's here. And usually the target will line up, essentially you want the target to line up with gamma, charm, and delta, all have the biggest bars at the target. And that's essentially what you want to see. And then the target, what I've been talking about, largest gamma bar above price. Okay, so if price is right here, once again, we want to see the large gamma bar above price for this. So let me give you a real example instead of me just drawing. All right, so check this out. This is the Greeks at 9:32 a.m. Eastern time. I'm going to make this, let's see, can I make this bigger? Okay, so this is 2 minutes after the market opened. This is what the Greeks look like. All right, so what do we see here? Okay, we have gamma right here. This is the Quantico gamma, and I'll explain this and what this means, but then we also have gamma right here. This is like the regular gamma. Quantico, the software I use, they have their own gamma. Where basically, I don't really know how to explain it, but you essentially want to look at both of these because we have the regular gamma out here. What they do is they find the median of the bars versus the average. It's something like that. I would have to, but essentially, like, the way I know is you want to look at both essentially. So for example, as you can see, where's the biggest gamma bar? Okay, if we go back, actually, let me just pull up another one so I don't have to go back and forth. Let's go back, okay? All right, so we're looking at setup number 1. Okay, our long pullback. So first thing we want to see is positive gamma. Do we have positive gamma? Well, yes, look where dotted price is. As you can see, we're in the positive zone. Negative zone is down here. So that means this setup is going to be valid based on what we see so far. Okay, we want to look for this setup if we're in positive gamma. Now we also want to see, we'll do this backwards a little bit. We want to see the largest gamma bar above price. Okay, so if price is right here, okay, we are positive gamma, and we also see the largest gamma bar, this green bar, above price. Okay, so these two check out, right? So that means what we need to do is we just need to look for the pullback area. Where's the pullback area? We want to hold above the flip. Okay, so if price is right here, we want to hold above this area, okay, between 560 and 561. Okay, this red bar is going to act as defense. Now, if we break this red bar, price is going to shoot down to this next somewhat big bar. All right, because again, it's like the stairs up, elevator down. As soon as we break this, we're going to shoot down. All right, now, so we basically want to hold this area, this 560, 561, even this 562. We want to hold above that area in order for price to get it to 564, okay, which is going to be our target. Now, next thing, confirmations. We want to see rising charm to the target, okay, which is 564, that green gamma bar, or right here, and delta leading up to target. Okay, so what does delta and charm look like? Right, look at charm, price is right here. What happens? The next bar increases and then increases again, right? So this checks out. We have charm leading up to target, rising charm leading up to target. And then we also want to see delta, right? Does delta also lead up to target? Well, as we can see, yes, we have pretty good delta right here and then the target, right? So we can easily get a nice trade long up to this target area. So essentially the best trade based on this, the best trade I can see based on just looking at this, not looking at the chart at all, right when market opens, we can see, let's look for pullbacks at 560 to take long and ride it up to, either 562, back to 562, or even all the way to 565, or 564, or let's hold 562, right, and ride it up to 564. That's essentially what we want to see. Okay, so now let's go to the actual chart and see what happened on this day. Okay, so we're going to go straight down to the chart. My white vertical line is the market open. Okay, and as you can see, what happens here. Market opens right here. We push up to 562, and we have our 560 line right here. Okay, remember, this is the absolute max amount that we could pull back. Okay, we don't want to pull back past 560. So any pullbacks, we basically want to take long to this 564. Okay, remember the 564 was the target. Okay, if we go back here, everything points to 564. The gamma, the delta, the charm rising to it. And then also on this chart, we have a big gamma bar here as well. So everything points to 564. We want to take pullbacks to the area unless we break 560. If we break 560, don't look for longs anymore, right? Based on this specific Greek chart. We don't want to look for longs anymore past 560. But if we hold 560, we want to look for pullbacks to take long to 564. As you can see, we got our first pullback here at 561, right? And what happens? We go straight to target. We literally hit it to a T. What happens? We pull back again. We hold this area, right? We got the buy signal here. So that was our trade for the day. That's a solid trade. This is on QQQ, but it's going to be the same on NQ. Okay, if you're trading futures like me, whatever QQQ does, NQ is going to do the same. They're literally tied together. So this would have been like 2 points on QQQ is around 80 something points on NQ, so that's an 80-point trade. Okay, and that would have been the trade for the day. Now, if we already hit the target, we want to look at the Greeks again down here at 8:30, which is actually going to be this chart here goes off of Eastern time. So this we want to see what the Greeks look like at 10:30 on here. Okay, so basically an hour after market open, see what happens, see if this still makes sense to take long. And then we broke above our target, right? So do we have more pressure building to the upside, right? What does that look like? Well, we see Charm has a big bar up here. This looks like it's 568. Okay, and we have a little bit of rising Charm up to that area. Let's see, Delta, we have a little bit of interest over here. Gamma, that kind of lines up. And then we actually have the biggest gamma bar here on this chart to 568. So there's a good chance if we break 564, we can break and retest it and ride it to 568. Okay, as you can see, I don't know if that happened today because I can't see the full chart. Just depends on, what the Greeks look like, at 11 Eastern time. So as you can see, but we did break above it, retested it, and then we made our move to 566. I don't know if we got to 568 that day, but that's essentially what you would want to look at. And even this, you would have got a nice little trade up to this 566 regardless. Okay. So that's a long pullback. Essentially, we have positive gamma. Everything's positive. We have Charm leading up to the target. We have delta interest up here. We have gamma here. This lines up, right? Everything makes sense that pullbacks should get defended until we go negative. Okay, we should hold this 560 area. Okay, you can see Charm had a huge bar here as well. Everything tells us that there's a high chance we're going to hold 560 and we're going to get to 564. So hopefully you guys can see that, and you can see 560 is right here. Okay, we can kind of line it up with candlesticks in the chart. All right, this is support area from yesterday. This makes sense. All right, let's take pullbacks here. That makes sense. We didn't get a signal right here, but if we did, this pullback probably makes sense, right? That trade makes sense. So that's the first kind of setup. That's probably my favorite setup to take, honestly. It's just a long pullback. All right, the next setup is just basically going to be the same thing, but on the flip side, a short pullback. Okay, that means essentially like the trend is down, we're negative, right, on the gamma, and we want to take the pullback short, right? So conditions for this, obviously we want to see negative gamma. We also want to see us break through the red gamma bar. We can even go to the first example and up here, if we broke 560, then we would look for the short pullbacks, right? So essentially, let's say price opened up and we break 560. We want to see something like this, a short signal right here, right? And then take it down. Okay, that's a short pullback. That's essentially what we're doing now. But we didn't do that day because we had positive gamma. Okay, so sometimes we'll open up negative gamma. And we also want to see us break through the red bar. Okay, because remember the red gamma bar is going to be defense, right? It's going to kind of act as support, essentially. So the pullback is we want to hold below the red bar. So going back to that example, right? If we break 560, we want to see us hold below it because 560 was the red bar, if you remember. Okay, going back here, 560 is the red bar. We want to hold below that red bar. And then we want to see confirmation, same exact confirmation. We want to see rising charm to the target and delta leading up to target. The target is going to be the gamma below the current price. Okay, a big gamma bar below current price. Okay, so let's look at a real example. This is another Greeks chart, right? 2 minutes after the market open is kind of when you want to look at this. Okay, and as we can see, what happens is are we negative gamma right now? Right? Did we break through the red gamma bar? As you can see, the dotted line is where price is. Okay, Yes, we broke through the red bar. We broke through the red bar, and we are negative gamma. Okay, these bars are negative, as we can see on this axis here. Okay, so that checks out. Pullback, hold below red bar. Okay, easy. What's the red bar? 565. Whoops. 565. We want to hold above 565 or hold below 565. My bad. Okay, that makes sense. Okay. So yeah, we want to, like, most ideal setup is, we hold below red bar and we take the sell signals, right? Or we can even pull up to the red bar and take that sell signal. Basically the break and retest, right? Confirmation, rising charm to target and delta leading up to target. Well, let's figure out what the target is first. Gamma below current price. Okay, so if we look at this chart, where's the gamma below price? Well, we can see, I'm seeing this bar stick out. Okay, we want to see a tall gamma bar, tall gamma bar, tall gamma bar. Or sorry, this is delta. Let's not look at delta yet. Let me just erase this. Okay. So we see tall gamma bar, tall gamma bar. This is going to be our target. All right. And now we want to see a confirmation, rising charm to target and delta leading up to target. All right. So what does the charm look like? As you can see, price is right here. What is this target? That's going to be 564, 563. Do we see rising charm? Okay. Yes, we do. As you can see, charm rises, charm rises. And this is even telling us we could get to 563 actually, based on the charm. As you can see, it's rising until here it drops off. There's a good chance we get to 563 and even 560 actually. You can see there's a dramatic drop off right here. Okay, you see how there's a dramatic drop off? Well, let's look at the gamma. As you can see, gamma's right here at 560. Dramatic drop off. Okay, 560 on this gamma, pretty big drop off. And we also got the delta right here, 560, dramatic drop off. So everything's pointing that we could actually take short pullbacks until we get to 560, as long as we hold above 565. So that would literally be my plan for today, not knowing what the chart looks like. We want to take pullbacks that hold below 565 to 560. That's our plan. It's a very simple plan. Okay, based on what everything is telling us. Okay, let's look at the chart results. Okay, we should have opened up at 564, as you can see right here. 564 is where we opened up. As you can see, what happens here, right? What is my red line right here? My red line is 560. As you can see, we got our first little pullback here. I mean, again, when we drop below negative delta, we usually sell off quick, right? So we're very negative right when price opened. We got this little pullback. We didn't get a sell signal until here, which is the only bad thing about this trade. But when we would have entered this would have been 561. Again, everything was pointing to 560. We could have got a nice little point off of here. And a point on QQQ is still like 40 points on NASDAQ, which is still a solid trade. 40 points is very solid trade. And the risk, as far as where to put your stop loss, usually I like to put it below the pullback low. In this case, we didn't get a pullback. We just got a sell signal because there's so much momentum selling off. And in this case, I would literally just put it above the signal candle, like right here, since our entry would have been right here. Right at the low of this candle where we got the sell. Then you take it to target, right? This would have been like a 1.5 risk reward ratio. That's a nice trade. It's a solid trade actually. So yeah, as you can see, once we got to 560, we kind of just chopped around, right? And this is because, again, we can see that literally everything dropped off after 560. I mean, that's going to be super high probability. Everything completely drops. This is 560, right? Look how everything just completely drops. Okay. 560, completely drop. 560, completely drop. Okay, so that makes sense. And right? Looking at our confirmation, we basically have rising charm all the way there. We have strong delta. We have pretty good delta all the way there. And we also have a nice gamma bar to 560 as well. Okay. So that is a short pullback, essentially the same thing as a long pullback, but on the flip side, when we open up negative or we just turn to negative throughout the day. Hey guys, real quick, I want to interrupt this video. Obviously, this is a private training I did for my OTS members. If you guys are wondering what OTS is, this is actually my private group. Well, OTS is the name of my strategy, but I do have a private OTS group where I trade this exact strategy you're watching in this training live every single day. I do the Greek analysis live every single day. And inside my private group, you also get access to my OTS indicator. It's a custom indicator I created that acts as confirmation on when to enter when we get to those key levels using the Greeks. So whenever we get to the key levels, I wait for my signals to go off from the OTS indicator and take the trade. So anyways, guys, if you're interested in joining the private group, it's not open to the public. I like to keep it, smaller and more exclusive. So I'm able to help everyone inside. Obviously, if it was open to the public, we get thousands of people joining and I wouldn't be able to help everyone inside. So anyways, if you guys are interested in joining, obviously you're watching this video, I at least wanted to let you know that we do have it. All you have to do is go over to our website. It's otsignals.com. Once again, that's otsignals.com. Like I said, inside there, you'll be able to trade live with me every single day, this exact strategy. You get access to our private Discord community, a full course basically going over the strategy more in depth, like you're watching in this video, and access to that OTS indicator that acts as a great entry signal once we actually get to those key levels. So anyways, just want to let you guys know about this. If you're interested in joining, just go over to otsignals.com. And with that being said, let's get back to the video. All right, guys, had to take a little break there. But anyways, moving on, setup number 3 and 4 are kind of like just reversal trades where the first two are basically trend pullbacks. So this is going to be the long reversal. Okay, so the conditions are you want to see us at a large gamma negative bar. All right, that's going to act as defense. Let me actually move myself. Confirmation is going to be the next gamma, delta, and charm bar, right? So all three of them is going to be significantly smaller and fade away. Okay, that's going to tell us that there's no more interest below this negative gamma bar, right? Meaning there's no more interest, there's no more buyers below the price, right? What is price going to do? It's going to go back up. If we are at a level, right, we start trading down here, we're at a big gamma negative bar at this price level, and there is absolutely no interest down here, right? What's going to happen is we're probably going to come back up. It doesn't mean you have to trade it all the way back up to highs, right? You just, trade it back up to the next big gamma bar, right? And that's the target, back to gamma/delta bar, and you're going to get a solid trade out of it, right? Again, 1 point on QQQ is like 44 points on the NASDAQ, right? So that's really all you need. Anyways, let's go ahead and show you an example of a trade like this. So these are the Greeks at 9:32 a.m. Eastern time. This is actually a trade I took this week. And what do we see here? Okay, obviously price is not there yet, but if we're, the market opened up 2 minutes ago, we could plan out our trades, right? One of the trades we could plan out is this long reversal. Hey, listen, if price got down to this 560 area, this large gamma negative bar, right? Notice how much it drops off on that next bar. You can see there's no interest down here, right? There's very little interest down here. So we can also look at the delta. We can see delta also drops off right after 560, same as gamma. And we can also look at the charm, which is charm's going to be the most important, right? 560 is that large gamma negative bar that lines up, and look how much the charm drops off as well. Okay. So, the charm is basically saying, like, even if there was a lot of interest on delta at 559 or on gamma at 559, There's no pressure for that to happen anytime soon because the charm has no time decay there, right? It's very small. So that's basically what that means. But anyways, let's go ahead and move on and show you what the chart looked like when we got down to 560. Okay, as you can see, around an hour and a half into the market, or actually 2 hours into market open, we finally touched 560 right here. We didn't get a buy signal because we're too choppy around here, so it didn't signal anything, but we got it on the second pullback. Okay, and as you can see, we got a nice bounce up, and we can actually look at the Greeks to see where we want to actually take this back to. So if we got down to 560, okay, where would it make sense to take it back to? Probably 562, this next like a little bit bigger bar. Delta, same thing, and charm, same thing as well. So probably 562, which could be a potential 80-point trade. Now keep in mind, we got in a little late here, right? We would have got in probably, yeah, right here. So we would have already been close to 561. So I'm pretty sure, yeah, this trade was 562 was like right here, right? Or a little higher. Okay, so you could have got a decent trade out of this. Not a huge trade. It was just unfortunate we didn't get a signal here. And then, you know, typically this one got pretty close, but I'd rather us at least touch the line, especially on these reversal pullbacks, especially after a huge sell-off like this, just because you don't always want to be the first buyer down here unless it really gets into the zone. Then it's fine too. Where in this case, we took this one because, you know, for one, we touched the line already. And for two, this is like a higher low now that we actually came down here. So this would be a way better setup. The most ideal would have been, you know, taking it right here, right? Or getting long right here. But as you can see, it just didn't print a signal, which is fine, right? That happens sometimes. And if you missed this, we could have got another one down here that went up a bit. But anyways, that was the trade for the day. Either way, you could have got a solid trade out of it. So anyways, that should make sense. Like, it's pretty simple what to look for. You just want to look for those huge drop-offs, right? As you can see, huge drop-off, and huge drop-off. These all check out. All three have these huge drop-offs, and we're at this red bar. Not on Delta. Delta is not as important, but on Gamma especially, and Charm especially as well. So anyways, let's look at the other setup that goes with that. And this is going to be the short reversal. It's the same exact thing, except you're trading the short, right? So this means we're at a large Gamma positive bar this time, since we're looking for shorts, right? Confirmation is the next Gamma, Delta, Charm bar drops off / fades. Same exact thing, right? And target is back to Gamma / Delta bar. Same exact thing. You can see how setup and number 1 are very similar. And then setup number 3 and 4, like, you know, the same as well. So, I mean, really all you need to know is 2 setups, because setup number 1 and 2 are basically the same. Setup number 3 and 4 are the same. So just remember those 2 categories of setups, right? Reversal or pullbacks. Anyways, let's go and look at an example for a short reversal. So this is what the Greeks look like at 11:22 a.m. Eastern time. And what we can see, we can just zoom in here, right? We can see, we want to see a large Gamma bar, okay? And we weren't quite there yet, but we want to wait till we get here. And this bar should be 557, right? This is 555. 556, 557. And as you can see, there's a huge drop off, right? Now, this is 2 hours into the market open. What would happen if we were at this bar, which we were, right? And you're like, oh, it's a big green bar. This is where I should short, right? Because this is going to be resistance. Well, not necessarily. Okay, you can see that you have to look at this actual axis and see there's still $200 billion of interest over here at 557. The green bar, there's just a ton. There's 500 billion, right? But you can see when it goes from 200 billion down to almost, you know, This is probably like, I don't know, 100 million, 10 times less. It's just, that's what you want to see, that huge drop off, that 10 times less drop off, versus this is only like twice as less, right? So don't get confused just on the green bars or red bars. You got to look at where the huge drop off is and actually look at these numbers, right? This is near zero. And this is still 200 billion. So just because we're at a green bar, and as you can see, the gamma was even bigger here, right? So you have to look at where the interest is. So in this case scenario, right, the short reversal, where the market's probably going to top out is going to be this 557, right? We can easily see this just looking at the Greeks before it happens, okay? Almost no interest down here, almost no interest on the delta. Plus, we can also see the charm had very little interest after 557 as well, okay? Now, yes, there was some interest on charm at 560, but there was almost no interest on gamma or delta. Now, if we did get above 557 and then we start trading up there, then we'd have to see if that interest starts growing or not, right? But all we can see, and this is like, we're kind of trading order flow, right? As of right now, there's no interest building there. There's not really any interest. That could change. It's not as common for it to change, but it could change, right? So you have to understand that. So I do monitor the Greeks, right? I kind of like to look at the Greeks every 10 minutes or so. Most of the time, the Greeks from 9:32 a.m. Eastern time will stay the same throughout the day. For the most part, like the levels will all be respected. But, just depending on what's going on that day, if there's like big news that day or something, the Greeks can change significantly. So I do like to monitor them, especially right before I enter a trade. So just keep that in mind, right? But like, especially the charm will hold the same the whole day. You don't really need to check the charm throughout the day as much, mainly the gamma and delta. Okay, so just a quick little mental note for you if you want to write that down. Anyways, with that being said, we can see this is a clear short opportunity at 557, right? So let's go to the chart results, and we can see this is when we're looking at that, right? This is that 11:22 Eastern time. It says 9:22 because I'm 2 hours behind Eastern time on my TradingView chart, just in case you guys are confused. Anyways, as we can see, got a beautiful signal right at 557 after we hit the line, and this could have been our short trade for the day. As you can see, we absolutely tanked down, and we even could have just taken it. We really just want to take this back to that green gamma bar. That would have been, I don't know why I went back that way. That green gamma bar, which would have been 555. So if we go back to this, we want to see where's 555 and even 556. Again, this trade, we're probably risking like 15 points on NQ, if that. So even taking it back to 556, which is right here, that's like a 3 or 4R, honestly. It's like a 3 or 4R trade, and that's from 1 point on QQQ. And then 555 is down here. And I think that this is actually a half day, right? You can see at 10:30 and then it went to 7. So this is actually the next day. I think the lowest the market went on this half day was right here, right at 555.50. All right, so either way, it would have been like a 5-6 hour trade. So anyways, guys, that is the short reversal, right? And those are the 4 setups that I like to take. These are all A+ setups. They have a great chance of working out, especially when you take them with the signals. You're going to do really well with these, okay? So remember, the Greeks don't predict the future. They reveal pressure. They reveal pressure in the market. How much do these market makers need to hedge here? How important are these levels, right? And what is the charm telling us, right? Are we positive or negative gamma? Okay, looking at all these things, they reveal the pressure in the market, how much they need to move up, how much they need to move down. Do they need to reverse, right? Do they need to move up to this level first? Right, you guys can kind of see that. So combine that with your OTS signals, and now you're trading where institutions are forced to make moves, not just hoping for a breakout. We can see it in the actual data. We're not just looking at candlesticks or trend lines and hoping it works, right? We can see the actual data, and we're putting ourselves in the higher probability situation by only trading where the institutions are forced to make moves, right? By looking at those Greeks, looking at those levels, right? And when you're trading where the institutions are forced to make moves, they control most of the volume in the market. So if they're controlling 80% of the volume in the market, then what does that mean? You're going to be on their edge, okay? Versus just, hoping a move works out by looking at candles. That's kind of the philosophy, the idea behind this trading. The way to analyze the markets this way that's kind of the idea behind it. So now you're probably wondering, well, Chad, where the hell do you read these Greeks, right? Where do you actually read these Greeks? So I do use the software. Unfortunately, this data is not really available free anywhere that I know of. That's makes it like easy to read and puts it in charts. There's a couple softwares you can use. I've tried 2 of them. I like this one the best. It's called Quantico, and they just make it super easy. Like their bars are easy to read, and they have all kinds of other stuff in there. They have a community and stuff, but again, I'm literally just looking at these 3 or 4 charts. The gamma, the delta, the charm, and then the regular gamma. Okay, that's all I'm looking at. So that's what I use this software exclusively. Again, they have a lot of other stuff on here that kind of helps you, but I mainly just look at these and then combine it with my OTS indicator, and it works really good because, again, this is all you need for the levels and to be able to analyze the market. So anyways, this software, okay, I want to give you guys a full warning here. This tool does cost money. They can't, obviously they're not going to just put all this time into a software and make it free. So you got to keep in mind, this is simply a tool I use that helps me analyze the markets and make my trading plans each morning along with my key levels. So just want to warn you guys on that, it does cost money. So there's a couple options for this, right? Obviously, option 1, if you don't want to pay for the software, and it's $200 a month for those who are wondering, if you don't want to pay the $200 a month for the software, this is what I'm here for, right? You're paying me to analyze the markets every morning, trade live with you, and access my OTS indicator. This is why you sign up to OTS, right? For, mentorship, my help, trading live with me, community, the entry indicator, the OTS indicator, right? And obviously, ultimately, you're here because you want to be profitable. I believe you can be profitable without actually needing the software. You don't need the tool because, again, you have me, right? And I'm going to analyze what the tool is telling me and make plans and make levels off of that, right? Now, option number 2, if you're someone who wants to analyze the market yourself, you're more of a DIY person, right? There's nothing wrong with that, and I think that's good, right? So if you want to analyze the market yourself, you want to learn how to read the Greeks, right, each morning and have no problem paying for the software, then it will be worth it because, this is how I'm making my plans and my levels each day, which is crucial for trading. Right, it's going to tell me where I'm going to place trades at, where I'm going to look for those signals at. So my goal today was show you the best way to read the Greeks in this training that we did. So again, if you guys are fine with paying for it and you want to actually, analyze it yourself, then obviously, again, the software is going to be worth it. So if you guys want to check it out, it's called Quantico Cap. I do have a link in the description below. It'll take you straight to their website, and you can sign up. Like I said, it is $200 per month. I don't care if you sign up or not. That's not it's not my business or anything. But I want to show you how I analyze the markets, and this is the tool I'm using. Okay, this is how I'm doing it, reading the Greeks. Okay, so I just want to put that out there. This is not like an upsell or anything. This is just a tool that I use to analyze the markets. If you want to use it, cool. Read the Greeks yourself. Go ahead, feel free. If you don't want to pay for it, you're like, Chad, I'm not paying another $200 a month. There's no way. Again, this is what I'm here for. I post the levels in my plan every single day inside the Discord trading plan, and I trade live with you. And I actually will read the Greeks live on Zoom every single day, and you'll see me do that. So again, you technically don't need it, but if you want it, it'll probably be worth it if you want to learn how to do it yourself. So I hope that training was helpful for you. If you guys need help with this, because obviously this is going to be really confusing when you're just starting out, I trade this live every single day inside my OTS group. So you actually see me read the Greeks live, take trades off of it. You can see my exact trades. You can see exactly where I enter, where my stop loss is, where my take profit is, all that good stuff. If you guys want to trade live with me every single day and also get access to my OTS indicator that, again, acts as a confirmation on when to get in on those key levels we have marked from using the Greek data. You'll also get access to my custom indicator on your TradingView chart as well, printing out these buy signals that you see on my screen right here. Go over to otsignals.com, and like I said, you'll get live trading with me, access to the OTS indicator, and my daily levels and trading plan based on the Greeks that you saw inside this video. Hope you guys have a great rest of your day, and I will see you at my next video with another day trading lesson.